investment trusts to kick us off. It's been a better year for the sector. For those who don't know, the context is for some time now, trust share prices have, with very few exceptions, been some way below their stated asset values, indicating a lack of interest from investors. But in 2025, these discounts have started to narrow a little bit for various reasons. Val, where has that been most apparent and why?
Yeah, so I guess average discounts have been narrowing for a couple of years, and it's kind of like, the drop was very quick over 2022, and then now the recovery is kind of like going a bit slowly. So this year, so we were looking at data from the basically end of October 2024 to the start of November 2025, so about roughly a year. And the difference was about 3 percentage points in the sort of average weighted discount difference, coming at 13.6% at the beginning of November this year. So, it's kind of like gradual improvement. Incidentally, I should say the figure does exclude 3i Group, which is a 30 billion trust that is a whole, in many ways, separate matter, still trading at a premium. But so it's a gradual improvement that depends on a few things. On one hand, I guess you have had investors very, very gradually and very partially moving away from US stocks to an extent, or at least the sort of rally broadening out a bit. And obviously investment trusts are, they're active funds. They invest in a whole range of geographies, sectors, assets. So, anything that is not sort of entirely focused on the big US tech stocks is good for them. UK equities have also been having a good time, and a lot of investment trusts are just, listed on the FTSE 350. So again, that kind of helps. And then I guess the main thing has been corporate activity. And basically what is happening here is that the sector has kind of taken note of the fact that there is less demand than there was for its assets. And so to an extent, a brutal way of putting it is that it's shrinking itself by doing buybacks, by merging trusts, and so returning capital to shareholders that way, and then discounts narrow as a result. And you can see that when you look at kind of the investment trust subsectors where discounts have narrowed the most this year has usually been sort of a combination of good performance from the underlying portfolios and then some big corporate activity of some sort. So I guess some of the sectors where this has been notable has been growth capital, where discounts have narrowed a lot. There's been some corporate activity there, but also just kind of the underlying portfolio is doing very well. And you get Europe is kind of like a similar story.
Yeah, some of the assets there doing fairly well. What about the areas where those discounts haven't really come in, or in some cases have widened? What have we seen? What kind of sectors are we talking about there?
So it's kind of like a similar story to an extent, because, for example, so the sector where the discounts have actually widened the most is European property, and that's because the sort of the investment trust that was on a lower discount in that sector, which is Tritax, got taken over. So it's kind of like similar. And then you get...
So it's a case rather of not that the discounts have widened so much, but the one that was doing well has been removed. So the average therefore is wider.
Exactly.
For the remainder.
Yeah. So it tends to be that kind of stuff. Or you tend to get sectors where, well, for example, private equity is an interesting one, because private equity had seen a big narrowing of discounts, I guess, over the course of 2024. And then it kind of stalled there. So this year they've narrowed, I think, a bit further, but not a big movement. And part of that is because people are worried about exits, because people, sort of exit activity within the private equity industry has been slow for quite a while. And I think many expected that to kind of pick up again this year, and that has not quite happened. So you haven't seen like a big further narrowing of the discount this year.
Holly, I want to bring you in here because one corporate activity that has been a really big feature of the investment trust world, and indeed the entire UK market this year, has been buybacks. Can we put some raw numbers on these figures? Can we talk a bit about the sheer volume of buybacks that we've seen over the past 12 months.
Yeah, absolutely. So it's been another record year for buybacks. 2024 already had been a record year, but we've seen a big increase again. So year to date, buybacks are 35% higher than the same period in 2024. So yeah, quite a big increase at the moment. It's worth sort of pointing out, though, that not all trusts are buying back shares at the same rate. So a lot of this activity is being driven by a handful of trusts, Scottish Mortgage in particular. It's a big sort of contributor. So year to date, that's bought back 1.5 billion shares. As a comparison, Monks is the second largest contributor to buybacks, and that's only bought back 384 million shares, which is obviously quite a lot, but sort of nowhere near Scottish Mortgage levels. And I think that does, to an extent, raise the question of how effective buybacks are as a tool for closing discounts for investment trusts, even though they are very widely used. So yeah, so Scottish Mortgage has already said that it's still very committed to continuing its buyback program. I think they've set aside another billion to go towards that, but it's actually still trading on a double-digit discount at the moment, and that discount did widen in the sort of 6-month run up to September this year. So even though it bought back quite a big percentage of those shares during that period, so yeah, it's always a tricky one to know how effective they are.
It's a bit of a difficult situation, not quite damned if you do, damned if you don't, but there are trusts where it's worked okay, others where, as you say, maybe not so effective. On the one level, I think people right now, given these discounts to a greater or lesser extent, have persisted for so many years, people at least want to see trusts trying a buyback to show they are trying to do something. Equally, something we wrote about in the supplement in relation to Sabre, the activist investor, we've seen some cases there where it's taken a position in a trust on a discount. The board has then done some buybacks and Sabre has exited. But as soon as those buybacks end, or as soon as Sabre exits, who knows which one is the bigger driver, that buyback, the discount widens again. So it's kind of a temporary measure in some cases as well, which implies if you just keep buying back shares is the only way to keep doing it. But that creates problems of its own, of course.
Yeah, exactly. And I think that's why we're starting to see trusts try different sort of corporate activity measures, and why we're seeing sort of an increase in M&A in the sector and sort of different options. Because at the moment, yeah, there's a lot of trusts that are sort of struggling with very persistent discounts.
That's right. Yeah, it does seem maybe if last year and this year, the 2 years of buybacks, but we are now evolving to more dramatic measures. This is a good moment to talk about M&A and the merger activity that we've started to see in greater volume. Can we give some examples from recent weeks, recent months of the kind of combinations we've been seeing?
Yeah, of course. So I guess over the last year, we've seen a number of acquisitions. They've been primarily in the REIT and infrastructure spaces. And we've also seen quite a few mergers as well. So trusts are clearly sort of, yeah, feeling the pressure to try and attract some bigger investors and to, like you said, sort of stop any activists taking too big a position in their shareholder register. So in terms of some of the new merger entities that we've now got, there's Invesco Asia Dragon Trust, which sort of followed the merger of Invesco Asia Trust and Asia Dragon Trust. JP Morgan Global Growth and Income also merged with Henderson International Income and the JP Morgan vehicle, so that's a continuing entity there. There's also been quite a few mergers in the sort of European trust space, and we're also in 8 days going to probably see the merger of ABI Japan Opportunity with Fidelity Japan. So that's all sort of scheduled to go ahead, sort of pending some final votes. And yeah, they seem to have been doing fairly well, the sort of trusts that have merged so far. Often you do see the discount actually widen post-merger, particularly if there's not been an opportunity for sort of shareholders to be offered a cash exit. But actually, generally those trusts have either the discount stayed quite steady or it's sort of increased slightly, but not a sort of alarming amount. So yeah, it seems to be going fairly well so far.
In some cases, this is a situation where it feels like the strong get stronger, the big get bigger, because the ones which tend to be the continuing vehicles are ones which are bigger, and that may partly be because they're the ones with better performance. The others, the acquirees, on the other hand, are reaching levels which are maybe subscale, certainly nowadays, or feel they need to do something if they're going to continue in any form. So the mergers seem to be, the rationale seems to make sense, and so far a lot of those, as you say, are doing fairly well. This is probably a good time, though, to talk about the proposal this week we have seen, which I mentioned at the top, for Hickle Infrastructure to buy the renewables Is it the Renewables Infrastructure Group? That's its name, not the Renewable Investment Group. You get the idea from the name. But this has been quite a controversial move, hasn't it, Val? Can we say a little bit, unlike some various other mergers, this has only just been announced. There hasn't been a shareholder vote yet, so we don't know exactly what's going to happen. But it has been quite a controversial proposition. Can we talk about why some shareholders are upset?
Yeah, it's both expected and unexpected, isn't it? Because there has been a lot of talk about more M&A activity needing to happen within the infrastructure sector, but maybe we were not expecting it to look like that. So those two are two very, very big trusts. And the main basic problem with this is that they do different things. So HICO is what they sometimes call a core infrastructure fund, which basically means that it invests in assets that are considered fairly low risk. They're backed by government. So, it's the kind of things like within education, healthcare, that sort of thing. And it's quite a big spread of different types of assets. And actually, when, in the past, when we've talked about HICO having somewhat of a problem, it's been that, there's not really any growth there. So, it's obviously an income play, but you kind of need the income to grow over time to keep up with inflation. And there's a bit of a question there. But having said that, the income does look quite safe, and income investors do like that. And then on the other hand, TRIG, so the Renewables Infrastructure Group, is a renewable infrastructure fund, which means that it invests mostly in wind assets, although it's got a spread of different technologies, but the majority of it is wind. And wind has not been doing super, super well this year because generation has been lower. And generally speaking, there are some questions and complications around the sector and its ability to cover the dividends. And because of that, it's been, a lot sort of lowly rated compared to the sort of core infrastructure trusts. So basically, the problem that some shareholders have with this merger is that, so if you're HICO and if you're invested in HICO, you don't necessarily want exposure to TRIG. And HICO shareholders, if the merger does go ahead, they're not really going to have a choice on the matter because for them, there is no liquidity option available. And on the TRIG side, actually, it's kind of the same thing to an extent because there is some cash exit option, but it's only about 11% of the shares. So it's not loads. But basically, the idea seems to be that it's a pretty good deal for TRIG shareholders. It's not necessarily apparent why HICO shareholders should be happy with this.
The exit opportunity is one big issue, isn't it? Certainly when you think both trusts before the deal were trading on, I think TRIG a 34% discount, HICO 23%. You don't really want to crystallize that, certainly if you probably bought in at a higher level, but you don't have an exit opportunity to get out if you disagree with the merger. So they're kind of stuck with it. Equally, I think for some shareholders, HICO shareholders are probably against it. They probably don't want the exit opportunity. They just want to be able to continue to hold their existing trust in its existing form. It's interesting as well, though, isn't it, to see some of this initial reaction. On the one hand, the manager of both these trusts is the same company, so their rationale is quite clear. I think to an extent they want to combine the two. There's certainly more questions about TRIG's future. I think some shareholders, certainly HICO shareholders, are also pointing out TRIG was going to have a continuation vote next year anyway, due to its persistently wide discounts. So that could have been an answer in one way. Can we say a little bit about some of that reaction, perhaps to the announcement, but also maybe our thoughts on whether this deal will go ahead? Because there has been some negativity. Equally, there are people who are incentivized probably to vote in favor.
Yeah. I think it's quite tricky to sort of picture how this will play out, because on one hand, you'd imagine that they wouldn't lightly announce something this big if they didn't have a reasonable level of confidence that they could pull it off.
Mm-hmm.
And the reason I think why they think they can pull it off is that they said they talked to the big shareholders. And basically here, the big shareholder is Rathbones, which has got about, I think, 12% of the shares last they disclosed. And so wealth managers, I mean, this is something we've been talking about for quite a while. Wealth managers, which are big owners on investment trusts, have also been consolidating. So, for example, Rathbones obviously took over Investec, and they like big vehicles because they like liquidity. And so if a trust is not above a certain size, they're not even going to consider buying it, basically. So there are some reasons why probably this is happening. Equally, on the other hand, for example, so CG Asset Management, which is the company that runs the Capital Gearing Trust, which listeners might be familiar with, they've sent out a letter. So they've got about 0.9% of HICO shares, and they are not happy with this, and they said other shareholders should vote against. So the letter is quite clear, and it says, so quote, many investors like us had made an explicit decision not to be invested in Trig and have no desire to be forced to do so by the board of HICO. End of quote. So that's not that's not very promising, is it? So I think it all depends, I guess, on the numbers when it comes to the vote. There will be some retail investors. I don't know to what extent. If there is really a lot of pushback, they will need retail investors to get sort of behind the pushback. Because otherwise, obviously, when there's big shareholders, they do tend to have a lot of power. So it might happen. But yeah.
The other thing being, if you're big shareholders in both, of course, you're incentivized to find a solution for Trig. And if that means a slightly less good solution for HICO in the short term, then you're probably okay with that. And certainly, I mean, we should say the case management is making is for a stronger entity overall and a good performance, good dividends, possibly even an increase to the dividend in the years ahead. But people are obviously very focused, understandably, on the change in assets. It's interesting, too, to note, I mean, this is all still very early days. I see one broker suggesting the vote will be relatively soon, so mid-December. But they were saying their central assumption is the merger is either abandoned or perhaps another suitor makes an offer for one of the two trusts. So even though we haven't heard many big voices come out against it publicly, that is an interesting reading of the runes for things as they lie. We should talk a little bit, I mean, it's all very much implied from what we've been saying, but we should just mention the initial shareholder share price reaction to this deal too.
Yeah, it wasn't great. So Trig went up slightly. HICO on the day at one point, I think, was down about 8%. So clearly not everybody was pleased with it. I guess on this note, from HICO's shareholder perspective, there is a risk that they end up with a wider discount if the merger does go ahead. They're kind of like taking on some of Trig's discount in a way. So that is the danger. I guess one other thing we could mention that acts as a bit of a counter argument is that there is not a lot of options in terms of core infrastructure trusts left. Because another one that had very safe sort of government-backed revenues was BBGI, which was also taken private. So now it's down to HICO and the other one, which is IMPP. So to an extent, there won't be, that's kind of like...
You have nowhere else to go. You must stay. And, well, maybe more reason they will try and fight for it to stay in the current form. But yes, if this does get voted down, there would probably still be some question marks as to what HICO would do in the future, because they clearly are thinking about ways to develop the trust. So there'll be more questions there. But this is still very early stage, as we say, so we'll move on for now. Let's talk a little bit about SABA, the activists, because they have been taking a lot more stakes in a lot of trusts recently, following on from the high-profile requisitions they made at the start of the year. Those were unsuccessful, trying to get seats on various trust boards. But if you think about all the things we've been talking about, not the HICO example, but aside from that, a lot of the activity does seem to have been prompted by either SABA being on shareholder registers or boards concerned that SABA might appear on registers. So that has really hurried along a lot of this activity. We'll talk about some of the trusts they have stakes in a moment. But Holly, I just wanted to mention, first of all, the Smithson proposal, which Smithson, run by Fundsmith, of course, quite a high-profile trust and quite a notable piece of corporate activity there, and a notable announcement a couple of weeks ago. Can we talk about that?
Yeah, absolutely. So Saba had been building up quite a substantial stake in Smithson, and then earlier in November, the trust has announced that it's basically planning to ditch the investment trust structure and convert itself into an open-ended fund. And yeah, the sort of subtext is that is as a response to pressure from Saba. So far, in terms of the details they've released, they've said that the investment strategy for the new vehicle will stay the same, and they'll keep the manager, and that all existing shareholders will be offered a full cash exit. And I guess obviously the trust had been struggling with its discount again for a while, and the appeal for this sort of switch is that it means if you go to an open-ended fund, it removes the sort of share price factor entirely, so that kind of solves the problem in that way. And yeah, and I guess the next question is whether it might inspire some other trusts to follow suit, given how high profile Terry Smith is. And if this works well, then there's a potential that other struggling trusts might decide that this could be a good option for them. And yeah, Saba has already sort of managed to push forward these sort of conversions already. So earlier in the year, Middlefield Canadian, which was again sort of had quite big discounts, said that it was going to convert to an actively managed ETF. So again, slightly different structure, but moving away from that sort of investment trust vehicle. And again, that was sort of following pressure from Saba. So it does seem that this could become a bit of a trend for investment trusts that are struggling at the moment.
It will be something to watch, certainly. As you say, Terry Smith, the owner of Fundsmith, he doesn't run the trust, but that's their only trust currently, and soon they won't have any. And as a bit of a figurehead, maybe other people will think the same. I mean, the context, the conclusion from a lot of this discussion really is that the overall pool of investment trusts is shrinking one way or the other, isn't it? Be it by mergers or be it by rolling over into an open-ended fund in a couple of cases so far. Tender offers we haven't spoken about, but we've seen a lot of those too. So it does seem to an extent to be shrinking to perhaps meet the level of demand, which is lower than it once was. Let's talk a little bit about Saba's other potential interests. Val, we can't really cover them all off because it's been accumulating stakes in so many trusts, it feels like, in recent weeks. And can we do a little whistle-stop tour of some of the ones it's got an interest in at the moment?
Yeah, there's so many, isn't there? I think some of the new ones are Diverse Income Trust, RTW, Biotech Opportunities, Vietnam Enterprise Investments. There's a few that are in the alternative space, which I think we were maybe a little surprised about, because initially it seemed like Saba was a lot more focused on trusts that have underlying liquid assets, which kind of makes sense in the context of, they wanted to make money by discounts closing, and an easy way was one way or the other to get the trust to sell some of the assets and then return money to shareholders. And obviously that's not quite as easy to do if you've got a illiquid set of assets that take time and effort to sell. But yeah, among the illiquid are Go Street Energy Storage, which is the battery storage one, SDCL, Efficiency Income, and then within Growth Capital, there's Molten Ventures as well. And then it's still got stakes, for example, in Edinburgh Woodwide, which is like one of the original 7 it tried to sort of attack at the beginning of the year, and there's not kind of been a resolution there yet. So yeah, I guess they're trying, rather than doing the big spectacular thing every day, they're kind of like going for like smaller stakes, and then maybe get out via buybacks and making money that way. And there's sort of this threatening presence in the sector across a number of different trusts. And they're trying to make change happen that way now.
Yeah, certainly threatening for the trust boards, you would think. For shareholders, it depends, doesn't it? In some cases, they'll probably be quite happy to see discounts close up. In other cases, if it prompts a merger or rollover into an open-ended fund, some people would probably prefer the investment trust structure. But something probably did need to change given the issues with discounts, albeit we've had other podcast discussions in the past about how much discounts actually matter if you're a long-term shareholder, but that's a different story. Just the final bit on our investment trust discount, Holly, I wanted to talk about a few of the changes we've seen in relation to investment platforms on which one can hold these trusts. Because as with all investment platforms and with all types of vehicle and asset and wrapper, there are various ways you can hold trusts, various charges that will be levied on you depending on what you do and how frequently you trade. Each year we do have a little look at how those have changed over the past 12 months. And there have been a few examples this year, a few more than the last couple of years, it feels to me, examples of platforms changing their charging structures.
So Halifax, for example, it's SIP. So they've used to have sort of 2 tiers of flat fees depending on your portfolio size. And now they're replacing that with a 0.25 percentage fee. That is capped at £16.50 a month. But yeah, it could sort of change, I guess, how much you're being charged. iWeb is also planning to do a similar sort of thing, again, switching from a flat fee to a percentage-based one. Although it is currently moving its SIP from AJ Bell to Scottish Widow, so there's the fees actually waived at the moment, but it should be brought in from November 2028. So that's something to keep in mind if you do use that platform. And I guess whether or not that makes it more or less expensive for you as an investor using that platform kind of tends to depend on your portfolio size. I think, yeah, it just shows that it's worth sort of evaluating not just what's in your portfolio, but the platform on a fairly regular basis to make sure that it actually still suits you and where it's going.
Yeah. To me, it seems the case that, there are certainly more flat fees than there were a while ago, but it's definitely the case that some of those flat fees are, as you say, changing, and there's a higher flat fee in some cases. So maybe people tried to come in, really take some market share and thought, hang on, we're not actually making any money ourselves here. We need a higher fee. And that's certainly going to be something people should keep an eye on. Interactive Investor clearly was one that, I'm not sure necessarily pioneered, but certainly a high-profile early example of having the flat fees. And investment trusts are, as we also mentioned in the piece, good for flat fees, more so than funds. I think it's fair to say you do get more platforms who at least cap the fees at a certain level.
Yeah, I think that's worth keeping in mind. And also, you're less likely to trade an investment trust on a regular basis. So I think you don't have to worry about trading fees in the same way. So yeah, they are generally probably treated a bit better than sort of open-ended funds in that sense.
Yeah, it's very, very different if you have a percentage fee on an open-ended fund in a huge portfolio. As you say, you can really be racking up costs very, very quickly as your portfolio grows. Well, there's all kinds of things, as you may have gleaned from this discussion, that we cover in our investment trust special this week. We also have a lot of detail on which investment trusts are looking particularly attractive at the moment in the views of our writers, of external experts, fund professionals as well. So do have a look online in print if this has whetted your appetite.